Good afternoon. Welcome to LBMA webinars. Today we're looking at the outlook for investment and trading. Leading us into this webinar is John Reade, the Chief Market Strategist for the World Gold Council. John's done quite a bit of work at our recent conference on a session with a similar focus. So John, I'm just going to go through a quick housekeeping slide, but then I'm going to hand it over to you. If anybody has any questions throughout the entire webinar, just drop them into the Q&A function on your screen. It could be at the bottom or at the top, depending on which version you have. If you can't see it, don't know what I'm talking about, just send us an email to ask@lbma.org.uk and we'll get the speakers the questions via that route. Well, over to you.
Thank you very much, Taylor. And thank you for joining us today. It's an absolute pleasure to be joined by my two panelists. Tai Wong, firstly, he's an independent trader with over 25 years of experience trading precious metals and base metals, foreign exchange and emerging markets. He was most recently head of metals derivatives trading at the Bank of Montreal in New York, and previously worked at Barclays, UBS, where I worked with him for a few years in the dim distant past, and JP Morgan. So a real collection of the top banks in the precious metals world. Patrick Green is head of metals options trading at Citi, having been a prominent market maker on gold options since 2010. He was initially at Barclays and then from 2015 has been at Citi Commodities, where the business delivers a wide range of precious metals products through traditional and electronic platforms. So gentlemen, thank you very much for joining us. I'm going to kick off with a few questions. We've got some slides which we might switch to if we wish to illustrate a point, but otherwise we're just trying to keep it, very much as a relaxed question and answer session. And I guess the first question: why do you think gold has performed so poorly this year? And I'm going to ask Patrick to kick that one off.
Thanks a lot, John. Thank you to LBMA for having me today. So yeah, to kick off the session and answer your question. Look, in short, working within a commodities division at a bank, I think the short answer for me is we've seen rotation into other commodities and other asset classes. So the focus, which started in the second half of 2020 and continued into 2021, was an expression of recovery post-COVID, an increase in growth, otherwise known as the reflation trade. That was accompanied with US nominal yields pushing higher, and industrial commodities, ags, the energy markets, it's all rallying. So, gold on a relative basis came out of focus after having really been front and center in 2019 and 2020. And I think that's why it's performed poorly on a, both an absolute and relative basis for most of 2021. Caveat that with the recent performance. In addition to that, I think there's a general view that the peak of the cycle in gold prices may have been reached in 2020. We reached extremely low levels of real yields after the Fed's unprecedented QE program. And I think the question was, how much lower can these real yields push, and therefore how much more upside is there in gold? And again, that drove rotation out of the space. The final thing I'd point to is the second half of 2021 has been littered with micro stories in other commodity markets. So we've all heard of the gas story and seen the impact on prices, particularly in Europe there. We've seen a very significant sell-off in iron ore and some cost inflation in aluminium driven by emission and energy policies in China. And more recently, we've seen that copper inventories on the LME have reached all-time lows. So there's been a myriad of smaller micro stories in other commodity markets which have been attracting attention, and that hasn't been the case in gold this year. The final thing I would point to is after a period of wide growth across the globe, where the dollar tends to weaken, we moved into a period of time where there was maybe a little bit more concern about synchronized global growth. The US looked like it was going to begin to outperform somewhat, and we've moved into a little bit of a period of dollar strength, or the views in the FX market have certainly changed a little bit over the past few months. And I think dollar strength in the second half of the year generally has been a headwind to gold. However, again, over the past 2 weeks, 1 month, I think there's some interesting points that we can discuss in that space.
Sure. No, it's some very interesting observations there. Tai, anything you'd like to add to that?
I think, yeah, I think Patrick covered it, very, very well. I would just add that, I looked at the ranges that gold has traded in the past 11 years, and since 2011, and this is the narrowest year we've seen in that 11-year period. We're in about 15%, and for a good part of the year, gold would look like it would move, and then it would frustrate. 1830, so, tried there 4 or 5 times before it got through. Certainly the Federal Reserve, a little bit earlier than usual, perhaps, in June of this year, when it hinted at a taper could be coming, perhaps, a quarter sooner than expected, or half a year sooner than expected, a little bit of a surprise, capped gold for a bit. So it's, and there's, with crypto and other things, they're just sort of better places to put your money, especially if you're an investor and you're leveraged and you're looking to generate alpha. You need some volatility, and you weren't getting that in gold. You weren't really getting it in anything in the precious complex other than perhaps palladium.
Yeah. No, it's an interesting one, isn't it? And if I think about it, I think with the way Patrick said, it's the reflation trade. That's certainly how I've described it in conversations that I've had. We wrote a paper on it at the World Gold Council earlier this year, looking at how assets, and particularly commodities, actually perform in reflation, and to see gold underperforming the other commodities in the first 6 months of a reflationary trade is very common, and it makes sense. I mean, often during a recession or a crisis, you've benefited from owning gold because of its protective characteristics. And then when the economy comes back, whether it's a relatively slow recovery like we saw post GFC, or to be frank, come roaring back like the global economy has come post pandemic, it makes sense, I think, to be involved with assets that are correlated to economic activity. So reflation, very much the theme. It's interesting to listen to both of you from a commodities trading side, and Patrick, as I say, you're in the commodities business. Tai, you certainly were. See, the other things you mentioned, iron ore, nat gas, etc., haven't really focused very much in the conversations that we're having with investors, because we're talking gold at a much more strategic level than within a commodity space, and I think that's relative too. So, I still pay attention to all of the micro stories that I can follow in the commodity markets, but they're much less relevant, I think, in terms of certainly the investors that we speak to in gold. I think the other thing I'd characterize, and I've said this at various gold demand trends presentations that we have each quarter, 2020 was remarkable. I mean, yes, the gold price action was great, 25% up. Yeah, that's wonderful. But I have never seen the structure of gold demand change so much as I saw last year. We saw a collapse in the consumer side of the market. That's normally about 40% if you add up net jewelry demand and net demand of industrial or technology uses. That's about 40% of the market. That fell off a cliff because of the coronavirus pandemic. And then we really powered ahead in price terms because of investment demand, and specifically the investment demand that was visible via the ETFs. So 2021, in a way, is a normalization, not so much of price, but certainly of the elements of demand in the gold market. So we've had a big bounce back in consumer demand, and ETF purchases have flipped into slight negative. So all the boost we were getting on the demand side of the equation last year from the strength in ETFs has gone away and turned slightly negative. But interestingly, we've seen bar and coin demand, which picked up during the pandemic recession, more or less as you'd expect. That's continued to be really strong. And that's an interesting perspective. To me, it seems as if institutional investors, or maybe commodity traders, the rapid, fast money, definitely put gold to one side. And you can see that via the ETFs. Whereas on the bar and coin side, which is clearly more retail, because when they talk bars, they're talking small investment bars, not the big, large James Bond bars, as I call them. The retail investors have been showing a lot more interest in gold, and we're looking at numbers that could take us close to all-time highs in terms of bar and coin demand this year, if the momentum we've seen in the first 3 quarters has been maintained. Any thoughts on that retail versus institutional, Tai? I mean, you had clients with both of those, I would imagine, at BMO?
Yes, yes, we did. I actually, John, if you have access to slide number 3, just have a quick look for, and that's the slide on total gold ETF holdings. What's interesting is at the very beginning of the pandemic, ETF holdings, were at 90 million ounces, total ETF holdings. It jumped, rather quickly in the space of half a year to the highs of 110 million ounces. And it slowly trickled down, which, both Patrick and you mentioned a little bit earlier, down to just under 100 million ounces. So you could actually argue that at least the ETF folks are still a little bit long from pre-pandemic and may have to work through that. And I'll give just a brief anecdote. People in the market, people I know personally, last year, asked what I thought of gold, and I was quite bullish for the first time in quite some time. I'm personally long, and they got long, and sort of watched it disappoint. But primarily, they're all still holding on. So I think that there is some captive longs in there who perhaps I shouldn't say captive, but who are waiting for a rally. So the market isn't is still long from pre-pandemic. And in terms of the coins, definitely seeing a lot of interest in that. And for a time you saw it in the physical premium that you could get for certain higher grades of gold. And that's a space that a lot better than I do, John. You saw that very strongly. It's tapered off a little bit. We still have there's another chart if we want to just look very quickly at it. I wish I could. Sorry, where was it? It's that chart where due to the EFP disruption last year, a lot of gold went from that's chart number 5. I'm sorry. There you go. You found it faster than I did.
I knew what you were going to say. I'm good at this.
You are indeed. You've forgotten more about gold than I think I've ever learned, John. There's still plenty of gold in the U.S. So I think it's drawn down a little bit. There's certainly physical demand. I think you're probably seeing it in other parts of the world as well.
Yeah, no, that's a really good point. And one of the things that has happened with the recovery in consumer demand, particularly in India and China through the year, is that imports into both those countries have picked up a lot. So it's no surprise to me that we're starting to see the inventories drift a little bit lower on Comex, but that's a topic I want to come back to. Patrick, do you have any thoughts on the physical investment demand versus the ETF? Anything you care to share?
No, I don't have any specific observations on the physical side, but I think what you talked of this year is the change in demand from investors buying gold through ETF and through physical purchases and futures, and this year moving into the hands of retail. So I would say certainly the investor demand or interest in playing gold to the top side has certainly dropped off materially. If there was one or two aspects I would look at to illustrate that. First of all, in the options market in gold, typically you see the skew in the front end of the curve, or really across the whole vol curve, favoring calls. Certainly that was the case from 2018 through most of 2020. And for the first time, for the vast majority of 2021, you've actually had a skew in the front end of the gold vol curve, which is mostly favored puts. Okay. And that is certainly an illustration that there's a lack of investor interest in topside for topside options. It would also be an illustration of the fact that maybe producers are coming back to the market a little bit more in 2021 as prices have stabilized. So, yeah, I just wanted to talk a little bit of that the relative lack of activity on the investor side, as is illustrated by the skew in the gold vol market, and then add in that other factor that you know, producers and corporates, they tend to get a little more active as, you know, volatility calms down and some normalcy, you know, returns to the market. And we've certainly seen some evidence of that in gold this year, with recently some more borrowing in gold forwards and overall skew being under pressure as a result of producers buying puts and selling calls.
No, it's interesting. It's for those of you with grey hair, or in the case of Tai, any hair. I'm sorry about that. The change in the hedging that's taken place over my career has been incredible. When I started off in the market in the mid 90s, you know, obviously the size of the hedge book was more than 3,000 tons. I think it peaked at around 99, 2000, and we've seen that come all the way down to sort of, I think it's sub 200 now. So it'll be interesting to see whether, when we get the updated statistics that we get on the hedge book from Metals Focus, our data provider, whether we're seeing much indication of additional hedging coming through. Certainly, it's been up a bit, down a bit, up a bit, down a bit, really for the last 5 years. No real signs of sustained additions to the aggregate hedge book. Tai mentions a topic that certainly occupied a tremendous amount of my time last year, and I'm sure any traders on this call must have been even worse so, and that was the dislocation that took place between the Comex futures market and the OTC market. In other words, the blowout in the EFP. I've got a couple of slides that I put together actually here. I'll just get to them quickly. Apologies for the eye blind, but one of the things that struck me as I was updating a load of slides yesterday was the change that's taken place in the market since the beginning of November. And you can see it in a couple of ways. So there's two charts I'm showing on the screen here now. The left-hand side one shows aggregate open interest on Comex. So in other words, all the contracts, all tenors. And you'll see how that collapsed through last year, particularly when the EFP blew out and people closed positions. Longs and shorts, basically the whole thing got compressed down. And volumes fell back sharply as well. So we saw, you know, a collapse in the volumes trading, which is on the right-hand side down here. And to be frank, Comex has been a disappointment if you look at it in terms of open interest, if you look at it in terms of volumes, and I'm guessing therefore in liquidity that's going on since that dislocation. Now, the EFP's been pretty stable and steady, I'm guessing, since about the third, maybe the fourth quarter of last year. And now, for the first time, we've really seen a big pickup in open interest, and the volumes are getting close back to the levels that we saw last year. How's Comex? How's the FP market, Patrick? Is it working?
Yeah, thanks, John. It was certainly a subject that took a lot of our time last year, continued into this year, and I'm sure that's a theme across all trading desks at banks, certainly. So I would say that Comex versus OTC dislocations have normalized. However, as you pointed out, you know, the new state of play is just less liquid than it was before. So whereas the EFP previously would have traded in 10-cent increments in the interbank market, you know, the EFP is moving around by, you know, 50 cents to $1 during the course of the day. So it's more volatile. Okay, it's a little less liquid. However, the distribution of the EFP, or the top side of the distribution in particular, that larger move seems to be off the table. So that tail risk where the futures price moves materially higher than the gold spot price, I think is unlikely to happen again anytime soon. And there's a couple of reasons for that. You know, first of all, from our client base, we saw a lot of interest when this dislocation happened between futures and OTC. And as a result of that, we built up, you know, a fairly significant client interest above the market in the EFP. So by that, I mean, if we were to see futures trading at a significant premium to spot going forward, or even that could be expressed further along the curve. So you could see a deferred futures contract trading at a big premium to the OTC forward. We've got clients that are willing to come in and take the other side of that. So that's one element, which is tapping the top side of that EFP distribution. And the other element of it as well is that banks now genuinely have the physical infrastructure in place to be able to close that arbitrage loop between London and New York, whereas previously it was possibly a purely financial play. As a result of what happened last year, almost all banks had to actually implement the physical capabilities to move to refine gold, to move it to Comex warehouses. You can obviously see that on Ty's slide that he showed earlier on. So I think that more volatility and less liquidity in Comex futures is going to remain as a theme for some time. However, the possibility that we really see a big blowout and dislocation as per last year, I think is off the table. Just one more thing, I guess, to mention is that, and which could explain the lack of liquidity, is that when trading in a bank context or a fund context, if we take an 18-month or 3-year or whatever look-back period for some of our VAR models, we're still capturing that very large dislocation from whenever it was March 2020. And what that means is that banks overall are able to take less magnitude of risk in that EFP space than what they were before. There will be a point whereby that data set from COVID during this huge dislocation will roll out of VAR calculations. Maybe banks will get more comfortable in increasing risk taking in that space again, and maybe that's what will be required for a bit more liquidity and a little bit less volatility to come back in that space.
Yeah, it's really interesting, isn't it, when you think that of the difference between a theoretical arbitrage or maybe a financial arbitrage, and then the necessity to physically settle that arbitrage. And I think a lot of people learned the difference between the two big time last year. Similarly, I'm not surprised you talk about client interest, above the market in the EFP. I know if I'd been sitting at one of my former seats, I'd have been begging my boss to be able to open the accounts, and get everything ready to actually do that trade, because it was, if you had the contacts at refineries, if you had a source of metal, if you could get it across to New York, for a while there was a lot of money to be made there, and you can actually see it if you look at some of the banks that do publish detail in terms of their precious metals profits. You can see that last year was pretty good for them. Tai, what's your perspective? I mean, you sit in, you were sitting in New York. You're obviously active in the North American market. Okay, it's a global OTC market, but seated where you were, what was your perspective on how Comex has healed?
The EFP, I think Patrick covered, the vast part of what had occurred and what came as a result. I think the market is largely healed. We have plenty of metal in New York to be able to use to settle. I have noticed that over the past couple of months, the sort of the New York to London gold was trading around sort of level. Now it's certainly a bit bid for New York for sort of whatever reasons, but I don't think it will blow out again. But in terms of the traders trading, for many years, folks would when the EFP moved slightly out of line, would put on big positions, and it would be a nice sort of slow annuity for linear traders. And I don't think too many folks are doing that anymore. Just hard. I think the opportunity is still there, but it's hard to have a big position. And then if there's some sort of dislocation, it's not going to be an $80 dislocation. But what if there was a $4 or $5 dislocation? Hard to explain to management why, well, we just had that 18 months ago. How could you have that problem again? So I think you're getting more frequent trades, but the tickets are a lot smaller. And it's not just the gold EFP, the silver EFP as well. People will do 50 lots. That was a trade that was never done before, but people will do it because for whatever reason, that is a market that they want to keep well under control.
Yeah, and that I think that makes a lot of sense. One of the things that well, first of all, a joke in financial markets is that never in banking means about 3 or 4 years. And I think Patrick's explanation of a VAR look back probably explains why. I'm sure at some point we will see those large EFP positions being run again, and potentially with lower stocks in New York. But I'd agree with you, it's going to take a while to come through now. And that could be interesting, because if this increase in speculative interest that we've seen on Comex, which really started in the beginning of November in anticipation of the US CPI numbers, and then obviously with the CPI that was delivered, if that continues, I wonder if we will eat through the risk capital that is available for the EFP market. And I'm not saying we're going to blow out again like we did before, but it'll be interesting to see whether the Comex net speculative position could get back to the levels that it did pre dislocation, whether it could do that just yet or not, or whether it would actually start to cause stresses in the markets. I mean, I guess we'll have to wait and see if that does happen, but I wouldn't quite call it dead yet. I don't know whether the market could tolerate a 30 million ounce net long position on Comex at the moment. I just don't know whether there's the risk capital there to bear. Looking through the other questions we were chatting about before, I mean, from my perspective, the biggest issue that faces financial markets at the moment is inflation. And, you know, we've seen inflation described as transitory initially. It looks a little bit more enduring, I think, to most participants in the market now. And certainly, I think that what we've seen in gold in November, for the first time really through this blip in inflation or this transitory inflation period, it seems that gold is trading with inflation as opposed to against it. Previously, higher inflation prints, people would think the Fed would hike, that would be negative for gold. This time around, we had a high inflation print and gold went up. Am I correct in that, Patrick? Would you say that's a reasonable summary of what's happened this month? Yeah,
I think that's absolutely spot on, John. And it wasn't just the last CPI print, it was from the CPI print previously as well. So if I look back a couple of months ago, we got a stronger CPI print, gold traded down 1% as the dollar rallied, expectations for the Fed to hike increased, and actually it totally turned around that day and it traded back up 2% and closed higher. Fast forward to then the Fed and the next CPI print, and obviously the last CPI print again came in stronger. Again, you know, in the minutes after, gold traded slightly lower, and then we blasted through 1835 and probably had our biggest up day of the year, I'd venture to say, in gold. So yeah, it's really interesting that for a long period of the year, you know, people were talking about inflation. Inflation was high, but we really weren't seeing any direct feed through to interest in gold topside, or certainly in terms of any price momentum to the topside in gold. That has certainly changed over the past month. I think, you know, looking forward, you know, what I expect in terms of inflation, you know, views are clearly diverging. I think how the Fed reacts to what transpires over the next few months will be really interesting, and I think that's the key thing to watch, really. So if you take, for example, the economists at Citi, post the Fed, increased their expectations for Fed hiking in 2022 to 3 times. Okay, and at exactly the same time, gold rallied from a low of 1762, closing that week $40 higher, and now we're $100 higher than when we went into that Fed meeting. Okay, in the context of some in-house economists raising their expectations for the Fed to hike. So it's a really interesting time. Gold certainly has outperformed over the past few weeks. It's outperformed, as I mentioned, not only against the dollar, but even more so when you look in some of the cross-currency pairs as well. So gold denominated in euro, gold denominated in yen have had huge moves over the past couple of weeks. So yeah, look, I guess just to recap, it's great that gold has come back into focus. I think the direct correlation with inflation, as you said initially, that seems to be front and center at the moment, and clients are actively choosing to invest in gold again, or certainly speculate from a tactical perspective in relation to gold and inflation. I think that's going to remain in focus as we move into the December Fed meeting and on into 2022.
Yeah, I have to agree with that. Tai, any thoughts on that topic?
In terms of, I mean, the outlook for for next year, given where the Fed is, I guess, is what we're looking for, John.
Sure.
So I'm a big believer in recency bias, and that more recent data is more relevant than than data in the past. And we haven't seen inflation like this, certainly in the United States, if it doesn't remain transitory in a generation. The traders who traded that, 30 years ago are gone. So we're going into a period where we actually don't know what's going to happen. If the Fed hikes, 3 times, as Patrick mentions at the City Economist thing, do we get a tremendous flattening in the yield curve? What does that do for gold, right? You depress inflation in the longer term potentially, and you have higher rates. So far, gold has been great. Last night, it was trading at 1850, incredibly resilient, back at 1865, sort of actually the opposite of what's been happening so far this year. And I do think that, sort of the hawkish news is out. We have concerns in the world that I think next year positions us, pretty good for gold. The most immediate, who's going to be the next Fed chair? Do they want, Lael Brainerd, who would be, for some reason, it certainly checks some boxes. But if they change the Fed chair and it goes all pear-shaped, this administration will own it. And then there are some other things where certainly, on the warming plate, Russia and Ukraine, and a little further on, but potentially much more disruptive, China and Taiwan. So given the, sort of ordinary year that gold has had this year, I think it's a good time to be in it. One question I'd like to ask you, John, is, in terms of, all the price pressures, what do you think, if you have any thoughts on, owning the miners? I mean, owning the miners has been a difficult trade in recent years. Are they going to see their cost balloon, and are we better off actually going back into gold itself, the underlying, rather than the producers?
Yeah, we don't spend a lot of time looking at mining company valuations, but bad habits from the past and having looked at these professionally for a while means that I do get dragged back to it from time to time. It strikes me as the gold shares did okay last year, not as well as you'd have thought, I guess, with the gold price, and then have underperformed a bit this year. And I suspect that's the concerns about cost pressures coming through. One thing I would say, looking historically at gold shares, though, is if you think you're going to have a strong tactical move in the gold price, I mean, not talking about decades long or years long increase, but if you think gold's going to have a real go, either up or down, then gold equities are your leverage way to play that. And I don't think anything has changed particularly on that. And certainly some of the numbers that we've been looking at in terms of all-in sustaining cost margins and things like that, I mean, they're still in a very good position at the moment. So, if you think we're going to see a strong up move in gold, then gold shares could well be a very good way to play it. I'm conscious of the fact that we're running a bit out of time. I've stuck up on the screen, we want to hear from you, but so far nobody does. But I've got a couple more questions I might ask in the next few minutes, but if you do have a question, please come in via the screen function. It's been mentioned a few times on this call, mainly by Tai, the C word, which we're not supposed to use politely. I'm talking about crypto here. What are your thoughts in terms of the flows and the conversations that you had with traders and investors, Tai, about cryptocurrencies? Do you think there's a substantial amount of money being diverted from the gold investment market into this space? Or is it just crypto maximalists talking their book all the time?
Well, I don't know if you could put up slide number 7.
Yeah, I think I can do that.
From CoinMarketCap. I used to think, a year or so ago, that the Venn diagram between sort of people who like to trade gold and people who wanted to trade crypto, didn't have that much overlap. Oh, you just passed it. One more back. There we go. But I think my view on that has changed. And in part, I think I set up on my LinkedIn sometime in the, maybe a year ago, to give me notifications on crypto. And I would say that the sheer volume of people looking for quote unquote experienced crypto traders is very, very substantial. And you can argue whether or not, what does experienced mean?
I was gonna say, is that 10 minutes?
Right. So, but if you look at this chart, pre-pandemic, the total crypto market cap, 152 billion, excuse me, and it's ballooned to 3 trillion. Now, certainly a lot of that isn't new money. It's the, dramatic rise and from, in Bitcoin from, 20,000 to 65,000, and Ethereum up to its high, from very low levels to its high. But nevertheless, there's plenty of volatility in it. I mean, we've had a 15% range in gold this year. You could get yourself a 15% range in some of these, coins in, in a matter of, a day or so. So I do think that the opportunities there, both, sort of positive and negative, has attracted, certainly, if not a lot of funds, a fair amount of attention. And the fact that so many people are looking for crypto traders is probably a tell that, it has drawn some interest away. And I think the best way to play this is you need to have some gold. You should have some crypto as well. There's leverage in gold, but there's leverage in crypto. So have some of both.
Yeah, it's interesting, isn't it? Is that crypto started to rally as the reflation trade took off. And that was the time that gold started to correct. And I think that fits with certainly my understanding of what drives crypto prices, is that they are a risk-on trade. They're correlated to equities, particularly to NASDAQ and the high growth stocks there. So when the economy started to recover and those started to move, crypto came back to life again. I personally don't think there's much substitution between gold and crypto assets. I think they're very different. Maybe some speculative overlap, that's about all. Now, we've had a question, and I'm excited. And it's from Serge Gams, a almost colleague from when I was at UBS and he was at Metal. We would nearly closely work together anyway. And it's a question I can't answer because I don't do forecasts, as you know. Can you indicate what are the possible higher prices for gold and silver by year end? Now, before I come to Tai, I'm going to ask Patrick from an options perspective. Are we seeing any interest in the options market? I've heard talk about call spreads for December and things like that. Any strikes, anything there that could give us some indications of where we might get to?
Yeah, so very good question. Thanks for the lead into the option side there, John. So yes, December option expiry on Comex, which is 23rd of November. We saw a very significant position put on an 1850, 1900 call spread, probably just over 1 million ounces a leg. That was put on probably 2 or 3 weeks ago. We've seen some evidence of reduction in open interest on the 1850 strike, but certainly there's still a large position there. So I think that was put on around the time when we'd seen some pretty wild volatility in the bond market. I think the focus on inflation was starting to pick up again. 1835 as a important technical level that Tai had mentioned, had held a few times, and that has proven to be, thus far a great expression. And that was certainly the biggest premium outlay I've seen on a 1 month bullish gold expression in some time. So there's that was an 1850 1900 call spread. As I said, there's some large open interest on that over the next week. If I look beyond that, the next Comex expiry is the 28th of December. Amongst our client base, there's a few ways clients may express a bullish view. The most leveraged fashion would be they would be buying low delta calls outright, and then we move towards call spreads in equal volumes, and then we might move towards call spreads in kind of ratio amounts with a little bit less premium outlay and a little bit less initial delta. And our client base is kind of favoring the last one there. So I think I would say price forecasts of maybe, the first stop really in gold is kind of 1915, 1920. I think, some of our expressions have maybe believe the price could get up to 1950, 1975, but we haven't seen anyone, expressing a view of an explosion in the gold price to 2000 plus into the end of the year. Hopefully that answers the question, John.
It does very nicely. Tai, any thoughts?
I think the key level for gold in this cycle really is 1960. And that's where, the reason for that is that's where gold was trading when on the 9th of November last year, Pfizer announced that, its vaccine. And I think it dropped $100, tried to get back up to 1900, but really never saw it again. I think we could get above that level, then, gold is like a Veblen good, right? The more it's, the more expensive it is, the more people want to buy it. So above that, I think we're in a different world. I don't see it. So I think we could end up somewhere, say, between here and 1900. If they were interested in silver, I think silver, I think in this case is tracking gold. Hard to see it above 28. Maybe it gets to 28 if we get to 1960. But gold is I think the guide here.
Fantastic. Now, unfortunately, we've had a couple of questions come in, but we're right out of time. So to Cabello and Dan, I'll ask Taylor to make a note of these questions for me, and we'll get answers via email to you both. And I do apologize for having run out of time. Taylor, I have one more job. I've just remembered now. I told you I would nearly forget this. So we've been asked to come out with one key takeaway that we each got from this this call, and to give the guys a little bit of time to think about this. I'll go first, and I think my takeaway from this was I was really interested in the conversation that Patrick had and the discussion that he had regarding the options market, particularly the fact that the risk reversal was traded for puts over for much of 2021. It's a chart that I normally update, but I must admit I haven't been updating it for the last few months, and I must have missed the fact that the gold market was actually, call it complacent about the upside, or maybe fearful of the downside. So I found that interesting, as well as his comments about the upside strikes and the potential moves that we might get. Patrick, what did you take away from this?
John, I think your lead in on the CPI observation was probably my key takeaway. So, you know, I guess the question or the link between gold and inflation that did not seem to exist for much of the year has come back to the fore, and the very close direct relationship between a pickup in inflation and a pickup in the gold price over the last couple of CPI prints, I think, is very important space to watch.
Fantastic. And any thoughts, Tai? Did we manage to tell you anything you didn't know already?
Well, I think you expressed it the best in your chart on so the open interest and the price, and that it's finally picking up. I think we may have the same ideas, but sometimes expressing it properly and perfectly in your two charts is the right way to think about it. I think we're in a good period for gold. I think the next 12 months, next year is going to be quite uncertain in many ways, and it's a good time to hold this asset.
Well, I think one thing I'll round out by saying, and it's a comment I've made a few times. When investment banks were writing their outlook for 2020, they're putting this together typically in October or November of 2019. There were all sorts of expectations of growth and Fed policy and inflation, etc. Nobody had in there coronavirus pandemic. The only person that was expecting a coronavirus pandemic was Bill Gates, and gold delivered 25% in 2020. It's a hedge that worked for a Rumsfeldian unknown, and I think it still has a role in a portfolio for that reason alone. So I agree with you, Tai. I think one should hold gold, and it might help you when things happen that you don't expect, even if we don't get an inflation boost or anything like that. But Taylor, I'll stop there, hand back to you, and thank you very much for allowing us all to talk nonsense on the gold market for the last 45 minutes.
No, thank you very much for agreeing to participate. And as John did mention, I will collate any of the questions that were asked either during the webinar or that do come in afterwards, and I'll send them across to you so you can give them a lovely little reply. Moving on, again, thank you all for joining us in this webinar today, but we do have some other things coming up. So as you may know, we did release our responsible sourcing report year. I think it was last week. So to talk to you more about that, 25th, which is next Thursday, are Sakila Matza, Neil Harvey and Alan Martin, all from LBMA. If you do want to read that in advance, or you just want to read that, head to our website and you can read that there. So we have a few more events coming up in December. So that webinar is our final webinar for the year, and then we'll touch base again in January with our updates for Q1. But we do a few events. I think I can see John nodding his head. We have the members pre-dinner seminar, and we have the members dinner with LPPM and IPMI on the 1st of December. So that's in 2 weeks, so it's all very exciting. If you're currently registered and you're no longer able to attend, please let us know for either of the events by the end of today, so we can just update numbers, catering, make sure there's enough food, wine for everyone. And then we also have some training dates following that. So if you're brave enough to register for the training dates, the morning after a lovely dinner, we have introduction to Loco London starting at 9 AM on the Thursday, and then the subsequent course, how to use Loco London, starting at 9 AM on the Friday. So we have a few places left, so do get in touch if you are interested, and we can send you any information and the registration link. We'd love to have you on board. And that will be the final course for the year, and we'll have a few more in January. Well, in January in 2021. So we'll send those out when we have finalized all of those. And as you can see at the bottom of your screen, we have the conference next year in October. So the launch sale rate for the tickets ends on the 31st of December. So if you know you're going, you want to get the best rate for you / your company, I do recommend that you register for that before the end of the year to really maximize on the discounts, because it's quite generous and we want to see you there. So that's it from me. I look forward to seeing you next week if you are attending the webinar next week. Without any more nonsense from myself, some more chatter, I will say thank you to our panelists, and I hope you all have a lovely, lovely afternoon. Bye.